What if I told you that two of the most talked about cryptocurrencies in the market, stablecoins and memecoins, couldn't be more different, yet they're often thrown into the same conversation? One is built to be boring, the other designed for chaos. One wants to mirror the dollar, the other wants to ride a wave of internet hype. But here's the real kicker: both play massive, though opposite, roles in the world of crypto. Today, we're diving deep into what sets stablecoins and memecoins apart, not just in terms of definition, but how they function, why they exist, and what kind of investor they're made for. Whether you're just starting out or looking to sharpen your edge in the crypto space, this video will give you the clarity you need to understand these two radically different categories of coins and how they fit into the larger crypto ecosystem. Welcome to the Crypto Loop, the place where we cut through the noise, ditch the hype, and help you make sense of the fast-moving world of digital assets. If you've ever been confused about the difference between a coin that is meant to stay at $1 and one that can 10x or crash overnight, this one's for you. Let's start by zooming in on stablecoins. The term stablecoin might sound like an oxymoron to anyone who has watched the crypto markets for more than 5 minutes. After all, this is an industry known for volatility. Bitcoin can swing 5% in a day. Ethereum can drop 20% in a week. So what exactly makes a stablecoin stable? In the simplest terms, stablecoins are cryptocurrencies that are pegged to a stable asset, most commonly the US dollar. Their main purpose is to maintain a consistent value, usually in a 1-to-1 ratio. So 1 USDT, USDC, or DOGE should always be worth around $1. The goal isn't price growth, it's predictability. But how do they actually achieve this? Well, there are several different types of stablecoins depending on what's backing them. The first and most common are fiat-backed stablecoins. These are coins like USDC and USDT, which claim to be backed by reserves held in actual bank accounts. For every token issued, there should be a corresponding dollar or equivalent asset backing it up. Then you have crypto-collateralized stablecoins like DAI, which are backed by over-collateralized positions in cryptocurrencies like Ethereum. These use smart contracts to maintain price stability, and the system adjusts itself dynamically based on supply and demand. Finally, there are algorithmic stablecoins, an experimental category that tries to maintain a peg using algorithms rather than collateral. Some, like Terraust, have failed spectacularly, proving just how fragile this type of system can be when sentiment turns and liquidity dries up. So why are stablecoins so important? In short, they offer a bridge between traditional finance and decentralized finance. They give traders a place to park profits during volatile market movements. They make it easier to send money across borders instantly, without relying on banks or traditional remittance services. And in the world of DeFi, decentralized finance, they are the lifeblood of lending protocols, yield farming, and liquidity pools. In fact, many argue that stablecoins are one of the few crypto innovations that actually offer utility today. Not just speculative upside. They're used in everyday trading, international payments, and even as inflation hedges in countries where local currencies are unstable. Now, let's swing to the other extreme, memecoins. Where stablecoins are about function, memecoins are about fun. While stablecoins aim to replicate the predictability of fiat currencies, memecoins embrace unpredictability. They are, quite literally, built on meme's social media trends, internet culture, and sometimes pure absurdity. But despite their humorous origins, they've become a serious phenomenon in the crypto world. Take Dogecoin, for example. It started as a joke in 2013, just a fun little tribute to a Shiba Inu meme. No roadmap, no grand vision. And yet, it became one of the top cryptocurrencies in the world. Thanks in part to community support, viral culture, and yes, Elon Musk tweets. Shiba Inu followed, carving out its own ecosystem and spawning a wave of Doge-themed knockoffs. The key thing to understand about memecoins is that they are driven almost entirely by community sentiment. They have little to no intrinsic value. There's often no backing, no utility, and no long-term development plan. Their price movements are fueled by hype, influencer endorsement, and sometimes just good old FOMO. Now, some memecoins have evolved over time and started to build ecosystems, create utility. or even launch DeFi platforms, but most remain highly speculative and extremely risky. Many are launched without proper audits. Some are outright scams, rug pulls waiting to happen. And yet, they remain wildly popular because of their massive upside potential. Here's the deal: Memecoins are like lottery tickets. When you buy one, you're essentially betting on a viral trend. If enough people jump in, the price skyrockets. If the hype fades or the devs disappear, it crashes fast. And unlike stablecoins, where a 1% deviation from the peg is seen as a problem, a Memecoin can surge 500% in a day and crash 90% the next. That kind of volatility is a feature, not a bug. So now that we understand what each of these coins represents, let's talk about their roles in a portfolio and how smart investors think about them. Stablecoins are used primarily as a store of value within the crypto ecosystem. They provide liquidity, hedging, and stability. If you're an active trader, you're probably holding stablecoins to move in and out of volatile positions without going back to fiat. If you're in DeFi, you're using them for lending and earning yield. They're a core tool, not a speculative play. Memecoins, on the other hand, are high-risk speculative assets. They're not built for stability. They're built to capture attention and potentially deliver outsized returns. But it's important to understand the risk-reward profile. If you're allocating a portion of your portfolio to Memecoins, it should be capital you're fully prepared to lose. Think of them as speculative moonshots, not foundational investments. There's also a psychological aspect worth mentioning here. Stablecoins are boring by design. They won't make you rich overnight. They won't pump your adrenaline. But they're essential for managing risk. Memecoins, they're emotional. They prey on hype, tribalism, and the thrill of doubling your money in a week. That emotional high is addictive and dangerous. Understanding your own psychology is just as important as understanding the coins themselves. Here's an analogy I often use. Think of stablecoins as the cash in your wallet. It doesn't grow, but it gives you security, flexibility, and peace of mind. Memecoins are like buying a ticket to a high-stakes poker game. You might win big, but more often than not, you leave with less than you brought. And look, I'm not here to tell you Memecoins are evil or that you should only stick to stablecoins. The reality is, both play a role in the broader crypto economy. One provides infrastructure. The other drives adoption, culture, and engagement. They serve entirely different purposes, and smart investors understand how to use them strategically. But don't make the mistake of treating them the same. Don't buy a Memecoin thinking it as the next Bitcoin or that it has long-term fundamentals. And don't ignore stablecoins just because they're not exciting. They are a key pillar of how modern crypto markets operate, and as regulation increases, they'll likely play an even bigger role in bridging crypto and traditional finance. If you're building a long-term crypto strategy, use stablecoins to manage risk and stabilize your gains. Use Memecoins, if at all, with a high-risk tolerance and short-term mindset. Diversify research. Stay skeptical. And remember, if something sounds too good to be true in crypto, it usually is. If you've made it this far, you now understand one of the most important distinctions in the world of crypto. Stablecoins are built for preservation. Memecoins are built for speculation. One is driven by fundamentals, regulation, and real-world utility. The other is driven by memes, momentum, and sometimes madness. If you found this video helpful, do me a favor, hit that like button so more people can find the crypto loop. And if you're serious about mastering crypto, not just chasing pumps, make sure you subscribe. We drop weekly videos that help you build confidence and clarity in a world where most people are just guessing. Leave a comment below. What's your strategy? Are you holding any stablecoins for yield farming? Have you ever made or lost money on a Memecoin? I'd love to hear your experience and your perspective. Thanks for watching, and as always, stay curious, stay cautious, and stay in the loop.